On February 26, 2022, the Western world pulled the financial equivalent of a nuclear trigger. 7 Russian banks were severed from SWIFT, the messaging system that connects every major financial institution on the planet. Within 72 hours, the ruble crashed by 40%. Russian companies couldn't pay their bills. International trade ground to a halt. And for the first time in modern history, a major economy was forcibly ejected from the global financial system. But here's what nobody saw coming. Russia didn't collapse. Instead, they did something that should terrify every American who understands how power actually works. They built their own system, and they convinced the world's fastest-growing economies to join them. China, India, Brazil, Saudi Arabia, dozens of nations that control the majority of global energy production, manufacturing and population. They're all moving away from the dollar. Not gradually, rapidly. This isn't about Russia anymore. This is about the end of American financial dominance, the system that has allowed the United States to print money and export inflation to the rest of the world for 50 years. The mechanism that funds our military, our government, our entire way of life, it's cracking. And the cracks are spreading faster than anyone in Washington wants to admit. What you're watching is the most significant shift in global power since World War II. And most Americans have no idea it's happening because the financial media won't tell you the truth. They'll show you charts about inflation and interest rates. They won't show you the charts that matter. The ones tracking dollar usage in international trade, the ones measuring central bank gold purchases, the ones documenting the explosive growth of alternative payment systems. Those charts tell a different story. They tell the story of an empire in financial decline, and they tell it in numbers that can't be spun or explained away. Let me show you exactly what's happening, why it's accelerating, and what it means for every dollar you hold. Before February 2022, SWIFT processed 42 million messages daily, facilitating trillions of dollars in cross-border transactions. Every major bank, every international corporation, every government that wanted to move money across borders used this Belgian-based cooperative. It wasn't just a payment system, it was the nervous system of global commerce. Russia accounted for 1.5% of all SWIFT transactions. That might sound small, but it represented hundreds of billions in annual trade flows, Russian energy exports, Chinese manufacturing imports, European industrial payments, Middle Eastern oil revenues, all of it flowing through a system controlled by Western governments who could flip a switch and cut you off. And that's exactly what they did. The decision wasn't made lightly. European officials called it the nuclear option, because everyone understood what it meant. For the first time since SWIFT's creation, in 1973, the global financial infrastructure was being weaponized for geopolitical purposes. The message was clear: play by our rules or get cut off from the world economy. But here's what the architects of this strategy miscalculated. They assumed Russia would be isolated. They assumed other countries would watch and learn to stay in line. They assumed the dollar's dominance was so complete, so essential, that no viable alternative could emerge quickly enough to matter. They were wrong on every count. Within months, Russia had not only survived the SWIFT ban, but had begun operating through alternative channels. Chinese banks expanded their yuan clearing operations. Russian companies shifted to rupee payments with India. Middle Eastern energy producers started accepting payment in local currencies. The financial isolation that was supposed to cripple Russia instead accelerated the development of parallel systems that bypassed Western control entirely. The numbers tell the story. In 2015, 90% of Russia-China bilateral trade was conducted in US dollars. By 2024, that figure had flipped completely. 99.1% of Russia-China trade now happens in rubles and yuan, $0 involved. Two of the world's largest economies conducting $250 billion in annual trade without touching the American financial system. But this isn't just about Russia and China. It's about what their success demonstrated to every other country watching. That alternatives to the dollar-based system aren't just possible, they're profitable, and they're proliferating. China's cross-border interbank payment system, known as CIPS, was launched in 2015 as a modest alternative to SWIFT for yuan transactions. Before the Russia sanctions, it processed a fraction of global payments. Today, over 1,500 financial institutions in more than 100 countries use CIPS. Daily settlement volumes often exceed 300 billion yuan. That's roughly $40 billion flowing through China's payment system every single day. The growth isn't accidental, it's strategic. China designed CIPS not just as a messaging system like SWIFT, but as a complete clearing and settlement platform. When you send money through CIPS, you're not just communicating with another bank, you're moving value through Chinese infrastructure, denominated in Chinese currency, subject to Chinese oversight. And unlike SWIFT, which can be controlled by Western sanctions, CIPS operates under Chinese law. No American Treasury official can flip a switch and cut off access. No European regulator can freeze transactions. For countries concerned about financial sovereignty, this isn't just an alternative, it's insurance against Western financial coercion. The BRICS nations have taken this logic even further. Brazil, Russia, India, China, and South Africa collectively represent 40% of global population and 30% of world GDP. They're not just diversifying away from dollar payments, they're building an entirely parallel financial architecture. The BRICS Bridge payment system, based on central bank digital currencies, reached operational status in 2024. It allows member countries to settle trade directly through their central banks, without converting to dollars or using Western clearing systems. When Brazil buys oil from Russia, when India sells pharmaceuticals to China, when South Africa trades minerals with any BRICS partner, the transactions can flow through channels completely outside Western oversight. This isn't theoretical, it's operational, and it's expanding. Saudi Arabia, the cornerstone of the petrodollar system since 1974, announced in 2023 that it's open to accepting payment for oil in currencies other than dollars. This is the first time in 48 years that the kingdom has even suggested such a possibility. Saudi Arabia exports 17% of the world's crude oil. When the largest oil exporter signals willingness to break from dollar pricing, it's not just a policy shift. It's a tectonic movement in global finance. Russia has gone even further, mandating that unfriendly countries pay for gas in rubles. As the world's largest gas exporter, controlling 17% of global supply, Russia has the leverage to force this change. European companies that once paid in euros now convert to rubles through Russian banks. The energy that powers European industry is increasingly priced and paid for outside the dollar system. The data on global reserve currencies confirms what the payment systems already show. The dollar's share of central bank reserves has fallen from over 70% in 2000 to 57.4% in 2024. That's the lowest level in 30 years, and the decline is accelerating. If current trends continue, the dollar will account for less than 50% of global reserves by 2034. At that point, it's no longer the dominant reserve currency, it's just the largest among several alternatives. Central banks aren't just selling dollars, they're buying gold at the fastest pace since 1950. China, Russia, Turkey, India, and dozens of other countries have added over 2,000 tons of gold to their reserves in the past 2 years alone. Gold doesn't pay interest, it can't be frozen by sanctions, it can't be printed by central banks. For countries worried about financial weaponization, gold represents the ultimate hedge against dollar dependency, but gold is just the foundation. The real transformation is happening in digital currencies and alternative payment rails that allow instant settlement without Western intermediaries. The speed of this transformation is unprecedented. Financial systems that took decades to build are being replicated and improved upon in years. Technologies that seemed experimental 5 years ago are processing billions in transactions today. Alliances that appeared impossible during the unipolar moment are now operational realities reshaping global commerce. The transformation isn't happening in isolation, it's being accelerated by something most Americans don't understand. The weaponization of SWIFT didn't just hurt Russia, it sent a message to every country on Earth that the global financial system could be turned against them at any moment. And that message has fundamentally changed how nations think about financial sovereignty. Consider the psychology from Beijing's perspective. China holds over $3 trillion in foreign exchange reserves, the largest hoard of dollar-denominated assets in the world. But watching half of Russia's reserves get frozen overnight made Chinese policymakers realize a terrifying truth. Those aren't really China's reserves, they're hostages, assets that can be seized the moment Washington decides China has crossed a red line. This realization has triggered the most aggressive diversification campaign in modern financial history. China isn't just reducing dollar holdings gradually, They're systematically building redundant systems for every aspect of international finance. Payment processing through CIPS, trade settlement in yuan, energy purchases in local currencies, even satellite-based communications to replace Western financial messaging. The same calculation is happening in capitals across the developing world. India has authorized 18 countries to trade in rupees instead of dollars. The Reserve Bank of India didn't make this decision for economic efficiency, they made it for strategic autonomy. When you can settle trade in your own currency, you're not dependent on American banks to clear your transactions. You're not vulnerable to American sanctions freezing your payments. Brazil has signed currency swap agreements with China worth over $30 billion. These aren't temporary arrangements, they're permanent alternatives to dollar-based trade. When Brazilian soybeans feed Chinese livestock, when Chinese manufactured goods stock Brazilian stores, the transactions increasingly happen in reais and yuan. No dollars required. The momentum is becoming self-reinforcing. Every country that develops non-dollar trading relationships makes it easier for other countries to follow the same path. Network effects that once strengthened dollar dominance are now working in reverse. The more nations that accept yuan or rupees or rubles for trade, the more attractive those currencies become for other potential partners. This isn't just happening between adversaries of the United States. Traditional allies are quietly building their own alternatives. The European Union has been developing the instant payment settlement system since 2018. Japan and South Korea have expanded their currency swap agreements. Even close American partners recognize the risks of total dependence on dollar-denominated infrastructure. What makes this particularly dangerous for American interests is the timeline. Previous challenges to dollar dominance unfolded over decades. The pound sterling's decline as the global reserve currency took 30 years. The transition from gold-backed currency to pure fiat money happened gradually through the 1960s and 1970s. Financial changes traditionally move at the speed of institutional inertia, but digital technology has compressed these timelines dramatically. A new payment system can be designed, tested, and deployed in months rather than years. Central bank digital currencies can be programmed to settle instantly across borders without correspondent banking relationships. Blockchain networks can process thousands of transactions per second without human intervention. China's digital yuan is already being tested for cross-border payments with multiple countries. The system allows direct settlement between central banks without any intermediate currency conversion. When completed, this infrastructure will enable bilateral trade between any two participating nations without touching the dollar system at all. The technical capabilities exist today to process the majority of global trade without Western financial infrastructure. The only thing preventing wholesale migration away from dollar-based systems has been institutional momentum and network effects. But those barriers are eroding rapidly as more countries demonstrate successful alternatives. The geopolitical implications extend far beyond economics. Dollar dominance isn't just about convenience or efficiency, it's about power. When international trade flows through American banks, American regulators can monitor every transaction. When foreign companies need dollars to buy oil, they're subject to American financial regulations. When central banks hold dollar reserves, they're investing in American government debt. This financial architecture has allowed the United States to run persistent trade deficits for 50 years while maintaining global influence. America imports more than it exports, but the dollars flowing overseas eventually return to American financial markets. Foreign countries accumulate dollars from trade surpluses, then invest those dollars in treasury bonds, effectively financing American government spending. The system creates a virtuous cycle for American power. Trade deficits strengthen the dollar's international role. Dollar strength makes American assets more attractive to foreign investors. Foreign investment in American assets provides the capital to fund government operations and military expenditures. Military power protects the system that generates dollar demand. But this cycle only works as long as foreign countries need dollars for international commerce. If major economies can trade in their own currencies, if energy transactions happen in yuan and rubles, if alternative payment systems process the majority of cross-border flows, then the dollar becomes optional rather than essential. Once the dollar becomes optional, the entire foundation of American financial hegemony starts to crumble. Foreign countries no longer need to accumulate massive dollar reserves. They don't need to invest in treasury bonds to park their surpluses. They don't need to accept American financial regulations as the price of global commerce. The speed of this transition is what should terrify American policymakers. In 2020, less than 5% of Russia's foreign trade was conducted in non-dollar currencies. By 2024, that figure had risen above 50%. 4 years. That's how long it took for a major economy to fundamentally restructure its international commercial relationships. If the same transition happened across the broader global economy, the consequences for American living standards would be catastrophic. The United States currently imports $800 billion more in goods and services than it exports annually. This trade deficit is only sustainable because foreign countries willingly hold the dollars they receive from American consumers. When those countries no longer need dollars for their own international trade, they'll have much less incentive to accept them for American purchases. The value of the dollar would decline sharply, making imports dramatically more expensive for American consumers. The inflation that followed would make recent price increases look modest by comparison. Simultaneously, foreign demand for Treasury bonds would collapse as central banks no longer needed to park dollar surpluses in American debt. Interest rates would spike as the government competed with private borrowers for a shrinking pool of domestic savings. The fiscal position that allows America to run trillion-dollar deficits would become unsustainable overnight. These aren't distant theoretical risks. They're immediate practical threats that grow more dangerous every month as alternative systems gain scale and sophistication. The window for preventing this transition is closing rapidly, and most American leaders seem unaware that it is even happening. The next phase of this transformation will determine whether the United States remains the dominant global economic power or joins the historical ranks of former hegemons who thought their advantages were permanent. The signs are everywhere for those willing to see them. Those willing to see them. The most telling indicator of this shift isn't found in government statements or diplomatic announcements. It's buried in commodity trading data that reveals how quickly the foundation of dollar dominance is eroding. Until 2022, nearly 100% of global oil transactions were priced and settled in US dollars. By 2023, approximately 20% of oil trades were conducted in alternative currencies. In 18 months, the petrodollar system that Henry Kissinger constructed in the 1970s lost a fifth of its market share. This transformation accelerates with each passing quarter, because energy markets operate on long-term contracts and relationship-based trading. When Russia began demanding ruble payments for gas exports, European companies initially resisted. But faced with the choice between converting currencies or losing access to 17% of global gas supply during an energy crisis, they adapted. Those adaptation mechanisms, once established, became permanent infrastructure for non-dollar energy trade. Saudi Arabia's openness to accepting non-dollar payments represents something more profound than policy flexibility. The kingdom built its entire economic model around recycling oil revenues through American financial markets. Saudi petroleum exports generated dollar surpluses that were invested in treasury bonds, New York real estate, and Wall Street firms. This petrodollar recycling system provided the foundation for both Saudi wealth accumulation and American deficit financing. When the world's largest oil exporter signals willingness to break from this arrangement, it's acknowledging that alternative systems now offer comparable advantages with reduced risks. Chinese yuan can be converted to any major currency through Shanghai financial markets. Russian rubles provide direct access to European energy supplies. Indian rupees enable trade with the world's fastest-growing large economy. The dollar's convenience advantage has disappeared while its vulnerability to political weaponization has become undeniable. The cascading effects reach far beyond energy markets into the broader commodity complex that underpins global trade. Agricultural exports, industrial minerals, precious metals, and manufactured goods are increasingly priced in local currencies rather than dollars. Brazil's iron ore exports to China now settle in yuan. Australia's lithium shipments to South Korea clear in yuan. These bilateral arrangements seem small individually, but collectively represent a massive shift away from dollar-mediated commerce. What makes this transition particularly dangerous for American interest is how it's being institutionalized through formal agreements and technological infrastructure that will outlast current geopolitical tensions. The BRICS nations aren't just experimenting with alternative currencies. They're building permanent institutions designed to replace Western financial architecture entirely. The New Development Bank, established by BRICS countries as an alternative to the World Bank, now provides development financing in local currencies rather than dollars. Projects funded through this institution create economic relationships that operate outside Western oversight. When the bank finances infrastructure projects connecting Brazil to China or India to Russia, those commercial linkages generate ongoing trade flows that naturally settle in participant currencies. The Asian Infrastructure Investment Bank has followed a similar model, providing over $40 billion in project financing since 2016, much of it denominated in yuan rather than dollars. These institutions aren't competing with Western development banks on equal terms. They're offering developing countries something the World Bank cannot provide: financial assistance without political conditionality or currency risk. The technological dimension of this transformation is advancing even faster than the institutional changes. Central bank digital currencies are moving from experimental programs to operational reality across dozens of countries. China's digital yuan is already being used for cross-border transactions with multiple nations. The European Central Bank is developing a digital euro designed for international settlements. Russia has fast-tracked development of a digital ruble specifically to circumvent Western sanctions. These digital currencies solve the fundamental problem that has historically limited alternatives to the dollar system: settlement friction. Traditional correspondent banking relationships require multiple intermediaries, currency conversions, and settlement delays that make dollar-based transactions more efficient than alternatives. But central bank digital currencies can settle instantly across borders without any intermediate steps or conversion costs. Project M-Bridge, the multi-central bank digital currency platform, reached operational status in 2024 with participation from China, Hong Kong, Thailand, the UAE, and Saudi Arabia. The system processes real commercial transactions using central bank digital currencies that settle directly between participating institutions. When a Thai company buys oil from a Saudi producer, the transaction clears instantly through their respective central banks without touching the dollar system. The Bank for International Settlements withdrew from the M-Bridge project in October 2024, officially citing concerns about the platform's potential use for sanctions evasion. But the timing coincided with Putin's proposal for a BRICS bridge system based on identical technology. The message was clear: Western financial institutions would not participate in building infrastructure designed to bypass their own systems. This withdrawal has only accelerated independent development of alternative platforms. China announced plans to expand M-Bridge technology globally through partnerships with any willing central bank. Russia committed to building parallel systems for countries excluded from Western financial infrastructure. The technological capabilities that were being developed cooperatively are now being deployed competitively. The implications extend beyond payments into the broader architecture of international finance. Trade finance, the system of letters of credit and guarantees that enables global commerce, is being rebuilt around alternative currencies and institutions. Chinese banks now provide trade financing in yuan for Belt and Road projects spanning 70 countries. Russian financial institutions offer ruble-denominated credit facilities for energy infrastructure development. These alternative trade finance mechanisms matter because they create dependency relationships that run counter to Western interests. When a developing country receives Chinese yuan financing for infrastructure projects, those projects generate economic activity denominated in yuan. Local businesses learn to operate in yuan-based markets. Banking systems develop yuan processing capabilities. The entire economic ecosystem gradually reorients toward Chinese rather than American financial infrastructure. The speed of this reorientation varies by region, but follows predictable patterns based on trade relationships and geopolitical alignment. Countries that conduct significant commerce with China adopt yuan-based systems faster than those focused on European or American markets. Nations with adversarial relationships to the United States move more aggressively toward alternative systems than traditional allies. But even American allies are quietly building redundant capabilities that reduce their dependence on dollar-dominated infrastructure. The European Union's Instex mechanism, originally designed to facilitate trade with Iran, despite American sanctions, has evolved into a broader platform for euro-denominated international commerce. Japan's expanded currency swap agreements provide alternatives to dollar funding during financial stress. These systems exist as backup options today, but could become primary channels if political relationships deteriorate. The psychological shift driving these developments reflects a fundamental change in how political leaders think about financial sovereignty versus economic efficiency. For decades, the convenience and liquidity advantages of dollar-based systems outweighed concerns about American political control. Countries accepted the risks of dollar dependency because the alternatives were demonstrably inferior. That calculation has reversed for a growing number of nations. Alternative systems now offer comparable efficiency while eliminating political risk. Chinese yuan markets provide sufficient liquidity for major transactions. Digital settlement systems process payments faster than traditional correspondent banking. Alternative institutions offer financing without political conditionality. What we're witnessing isn't just the decline of a currency, it's the end of an era. The weaponization of SWIFT against Russia didn't just fail to achieve its intended goals, it accelerated the very outcome it was designed to prevent. The global financial system is fracturing along geopolitical lines, and the fractures are spreading faster than anyone in Washington anticipated. The dollar's dominance seemed unshakable 3 years ago. Today, it's optional for an increasing share of global commerce. Tomorrow, it may be irrelevant for entire regions of the world economy. The infrastructure for dollar-free trade is operational, expanding, and improving rapidly. The institutions supporting alternative currencies are well-funded and politically protected. The momentum is undeniable and probably irreversible. For Americans, this transformation represents the most significant threat to living standards since the Great Depression. A world where the dollar is just another currency is a world where America can't print its way out of debt, can't export inflation to trading partners, and can't maintain massive trade deficits without consequences. The adjustment will be painful, swift, and unavoidable. The signs are everywhere for those willing to see them. The question isn't whether this transition will happen. The question is whether America will adapt to the new reality or cling to the illusion of permanent dominance until the system collapses entirely. History suggests the latter is more likely. Empires rarely recognize their own decline until it's already complete.